Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to talk about Donald Trump's trade war and how it will impact the market. I will also talk about my investing strategy going forward. As always, I would like to give you more context first. At the time of making this video, the Fear and Greed Index is near number 4. This is the lowest I've seen over the past 5 years. The market is extremely fearful because of Donald Trump's trade war. Donald Trump's reciprocal tariffs are much worse than what the market initially expected. Now the market is concerned that Trump's trade war and reciprocal tariffs will lead the US into a recession or even a stagflation. Stagflation means stagnant economic growth or a recession combined with lower business earnings, high inflation, and high unemployment. This is the worst case scenario. This is why all the major stocks have been oversold recently. For example, the tech-heavy Nasdaq 100 has already dropped around 21% from its recent peak. By definition, the Nasdaq 100 is already in a bear market. Many individual stocks such as the Max 7 stocks, Apple, Nvidia, Microsoft, Google, Amazon, Meta, and Tesla have already dropped well over 20% from their most recent peaks. Most of them are oversold and greatly undervalued now. Just to compare, the S&P 500 has dropped around 18% from its recent peak, and it's almost a bear market. I've said this several times before. This bear market is essentially self-inflicted. Without these self-inflicted tariffs, the bull market will continue for at least this year. Donald Trump is purposely creating this bear market because the US has a lot of debt to refinance this year. Trump wants to bring in more external revenues through reciprocal tariffs for the US government so that the US government can reduce its trade deficits and national debt at the same time. More on this later. So in this video, I'm going to talk about Trump's trade war, how it will impact the market, at least for the short term, and my investing strategy going forward. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing videos a week that will help you become a great investor. Each video usually takes me more than 30 hours to make. So if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic value models for all the stocks I'm analyzing, so you will know when a company becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. The market is not always rational, especially during a market correction or a bear market. Typically, when the market is down a lot or when there are a lot of uncertainties in the market, such as now, most investors will sell their stocks even when most stocks are already oversold and undervalued. Then they will buy more money market funds or bonds instead because they worry that the market may drop even more. Of course, it's very hard to time the bottom. Most investors prefer to wait for greater certainty before buying stocks again. This means most investors will buy stocks only after the market recovers a lot and is no longer in a bear market. However, the biggest issue is that stocks tend to be much higher by the time the market has already recovered 20% or more from its recent trough. This trend will continue because the market is not always rational. The efficient market theory only exists in textbooks. Now, according to a recent article in the Wall Street Journal, total US money market funds have already surpassed 7 trillion. These money market funds have grown even more in recent weeks since Trump started his trade war and introduced reciprocal tariffs on other countries. I think this large amount held in money market funds suggests that many investors are still holding on to cash because they want the market to be more stable first before investing in stocks again. This is my best guess right now. If we look at this market emotion cycle here, I believe the market is near the bottom, or what I call the hopelessness and depression sell stage. At the time of making this video, the Fear and Greed Index is at around 4. The market has experienced the worst correction since the COVID-19 crash in 2020. Most tech stocks have already dropped more than 20% from their recent peaks, and investors are extremely fearful and depressed right now. The important thing to understand is that Donald Trump intentionally created this large correction. Most companies' business fundamentals have not changed at all. Many of them are even stronger and more profitable than 5 years ago. This means most stocks are undervalued and oversold now. Typically, once the market starts recovering and becomes more stable, many tech stocks tend to recover much faster than the broader S&P 500 index or even the Nasdaq 100 index. So we just need to be patient and wait for the market to recover. I've been building these market indicators with a friend. Here's a preview. We calculated the fair value of each S&P 500 company and compared it to its current stock price to create this S&P 500 valuation chart. This chart is very useful because it shows when the market is overvalued and overbought or undervalued and oversold. Currently, the entire market is deeply undervalued and oversold. Just a few months ago, during the Trump rally, the S&P 500 was mostly overvalued and overbought. I made a mistake and didn't sell many stocks when the market was overbought during the Trump rally. I thought it would be another bull market in 2025. More on this later. So how will Trump's trade war and reciprocal tariffs affect the US economy and the market going forward? First of all, we have to understand that Trump purposely started this trade war and caused this market correction because he wants to reduce the US $1.2 trillion goods deficit each year, reduce the 10-year Treasury yield, bring in more external revenues for the US government, force manufacturing back to the US, and of course, reduce the US national debt that's already over $36 trillion. So this trade war is not really about stopping fentanyl from coming to the US. Trump used fentanyl as an excuse to start this trade war. Of course, this is a huge pain for investors and many businesses around the world. The cost of goods for many companies will likely increase because of Trump's trade war and higher tariffs. Ultimately, these large corporations will pass the increased cost on to consumers. This means consumers will likely pay higher prices for most products imported from China, the EU, and other countries moving forward. Trump doesn't talk about this, but this trade war will likely hurt many US consumers, lower many US companies' profits, and increase US inflation even more. For example, Apple's iPhone components are mainly manufactured in Taiwan, China, and other Asian countries. As far as I know, China is now facing a 54% tariff on almost all products exported to the US. In theory, the cost of producing each iPhone will likely increase significantly. However, in practice, Apple's most important manufacturing partner, TSMC, has already begun producing chips for Apple in the US. This means the actual increase in iPhone's cost may not be too much. Going forward, I believe service and software companies such as Google and Microsoft will be least affected since they don't import many goods from China or other countries. Let's take a look at Trump's reciprocal tariffs to see if they make any sense. Trump is imposing a minimum 10% tariffs on US trading partners. More importantly, Trump is imposing much higher tariffs on countries that have the highest estimated tariff rates against the US. For example, at the time of making this video, Trump is imposing 54% tariffs on most goods imported from China. But the biggest issue is this. All these estimated tariff rates against the US are completely wrong and incorrect. Based on what I know, the actual tariff rates on most US goods are much lower than these estimated tariff rates. For example, according to the WTO, the EU's average tariff rate on US goods is around 5%. However, Trump is imposing a much higher tariff rate of 20% on goods coming from the EU. I don't think this makes any sense at all. If you look deeper, you will notice that Trump's way of calculating the reciprocal tariff rate is completely wrong. For example, Trump's team calculated that China's tariffs on US goods are around 67%. This 67% includes what Trump refers to as currency manipulation and trade barriers. The main issue is that Trump is applying the same calculation method to every other country. You cannot use the same formula to calculate tariffs on US goods for all countries because each country has different tariffs, trade barriers, and trade policies. Also, this formula is not the correct method for calculating the estimated tariff rate. This formula simply divides the US trade deficit with a country by the total US imports from that country. For example, the US trade deficit with China was $295 billion in 2024, while the US imported approximately $439 billion worth of goods from China. This means China's trade surplus with the US was roughly 67% in 2024. Trump refers to this percentage as China's tariffs charged to the US. Now, half of this 67% figure would result in the 34% reciprocal tariff rate set for China. Of course, if you study economics, you will know that this calculation is completely incorrect. I believe Trump is essentially using these reciprocal tariffs to force China, the EU, and other trading partners to lower their trading barriers and tariffs so that the US can reduce its trading deficit each year and bring in more external revenues. Hopefully, other countries won't retaliate with high tariffs and trading barriers. I mentioned this in my previous video. Trump intentionally caused this correction so that the 10-year US Treasury yield will be much lower. He wants this yield to be much lower because the US has a large amount of debt that's maturing over the next 12 months. For example, according to Google Gemini, the US national debt has already reached over $36 trillion. Approximately 33% of US public debt will mature in the next 12 months. This means the US will need to refinance around $9.5 trillion of debt over the next 12 months. Similarly, according to this post, Bloomberg estimated that the US has around $7 trillion of debt that needs to be refinanced in 2025. This is a huge amount compared to other years. This is why Trump is purposely creating this market correction. He wants to lower the 10-year US Treasury yield. This is my prediction. I believe most countries will not retaliate, especially the smaller countries, because they don't want to escalate this trade war. Escalating this trade war will be a lose-lose situation for everyone. Trump knows this, and he has the cards to force other countries to negotiate with him. Trump wants to make deals with other trading partners, especially China, the EU, Taiwan, Canada, Mexico, and others. I believe Trump will eventually ease some of his tariffs in the upcoming months once the US reach better trading agreements with its trading partners. And if the US heads to a recession or a stagflation, Trump will have no choice but to lower his tariffs. So what's my investing strategy going forward? I'll go through them one by one. First, I think it's important not to panic. The market cannot stay extremely fearful and deeply undervalued forever. Typically, a bear market lasts for about 1 year to 2 years. Then the bull market will eventually return. Second, it's very important to stay away from all the doom and gloom news, as well as the negative social media posts and videos. They always create even more panic and fear in the market and cause many investors to sell at the bottom. Third, it's a good idea to ignore the market and not even look at it. When the market is very fearful, looking at the daily price actions doesn't help. It's best to ignore all the market noise and just wait for the entire market to recover. Fourth, it took me many years to learn this lesson. Benjamin Graham said this: in the short run, the market acts as a voting machine. In the long run, it becomes a weighing machine. As of now, the market is not rational. It's extremely fearful because of Trump's tariffs. The market will be much more rational in the long run. Eventually, the market will recover and reach new highs in the long run because complete fundamentals, earnings, and free cash flows always determine stocks in the long run. Fifth, instead of focusing on the daily price actions, it's much more important to focus on business fundamentals and stock valuations. The market is unpredictable in the short term. However, the market will always recover by a lot and reach new highs in the long run because of the US economic growth and higher company earnings. Sixth, keep dollar cost averaging and buy the dip if you have the money. The best time to invest in high quality companies is when the market is extremely fearful. Seventh, stay invested and always invest for the long term. The market will eventually recover. Eighth, it's very important to invest in great businesses or high quality companies that have the strongest fundamentals, great long-term prospects, large economic moats, trustworthy and capable management, and increasing earnings over time. High quality companies always recover a lot and reach new highs in the long run. Ninth, when the market is in a large correction, I always like to study Warren Buffett's interviews and shareholder letters, as well as Peter Lynch's investing principles. And 10th, if nothing works, then it's best to do something else and focus on other businesses that can make you more money instead of looking at the market every day. The market will eventually recover. We just need to be patient and wait. Let me show you this stock portfolio because I want to show you several important investing lessons I have learned recently. This portfolio is separated into 3 different accounts. This is the first account. This account has been down a lot recently, mainly because of Trump's trade war. At the time of making this video, most tech stocks have already dropped more than 20% from their recent peaks. In this account, I have invested in MasterCard, Microsoft, Visa, Amazon, Google, TSMC, Meta, SML, and Nvidia. Nvidia is a new position here. The important thing is that these companies' business fundamentals have not changed at all. These companies are still the best and the market leaders in their industries. They have the strongest fundamentals, the largest economic moats, the best products and services, great long-term business prospects, and the most profits compared to other competitors. Their revenues and earnings continue to increase over time. It's extremely hard for competitors to compete with them. My strategy is to keep holding them for the long term and letting them grow exponentially over time. This is the second account. I already sold all the Apple shares in this account because I need to use the cash to pay down my mortgage and transfer the money to another account to cover the margin. Apple used to be a 10-bagger plus stock for me. I sold Apple many times before. If I combine all the gains from selling Apple across different accounts, the total realized gain is around $100,000 to $150,000 over the years. In the future, I will buy back a lot more Apple shares and increase its weight to around 10% once I have more cash. Recently, I also sold Amazon in this account, breaking even on this trade. I know selling Amazon doesn't make sense because the company is greatly undervalued now. I need to sell Amazon because I made a mistake of buying too many stocks over the past 12 months. I want to use the cash to cover the margin in another account. This is my third account, and it's the only one with margin. I wouldn't recommend anyone use margin because it can be very risky during market corrections or bear markets. Margin can force investors to sell stocks even when stocks are deeply undervalued as they are now. Just a few months ago, this account's total gain was around $150,000 before Trump started this trade war. Now, after Trump started this trade war, this account is down around $30,000. I made the mistake of buying too many stocks too quickly over the past 12 months because I thought the bull market would continue at least throughout 2025. My plan was to double this account and sell half of it to pay off the margin. I was too greedy. I realized I was wrong. This is why I had to sell Apple and Amazon, even if they are undervalued, to cover the margin. If I could choose again, I wouldn't use margin at all. Going forward, I will rebalance this account more and transfer more cash to this account as much as possible to cover the margin in case there's a margin call. This is one of the biggest investing lessons I have learned over the years. Don't be too greedy and don't use margin. Over the long term, I do expect this account will perform exceptionally well because almost all these companies are the best and most profitable in their industries. They have the largest economic moats, the best products and services, the best management teams, great long-term business prospects, increasing earnings, and increasing free cash flows over time. I also expect that the market will eventually recover by the second half of this year, which is the best case scenario, or by next year, which is the worst case scenario, once Trump starts easing some of his tariffs and reach new trading agreements with other countries. So when will the market recover? Of course, every correction or bear market is different. Typically, a bear market lasts around 9.6 months or roughly 289 days or about a year. Some can last up to 2 years before recovery starts. If you look at the historical Nasdaq 100 annual returns over the past 30 years, you will see that bull markets have occurred much more often and lasted longer than bear markets. The only major exception was the dot-com bubble in the early 2000s. Same with the S&P 500. If you look at these annual returns over the past 30 years, bull markets have occurred more often and lasted much longer than bear markets. The only major exception was the dot-com bubble in the early 2000s. Typically, after a year with a big market correction, the market tends to recover significantly over the following years. And if you look at the market since the 1950s, you will see that the US has gone through many major crises: civil wars, the Cold War, the Cuban Missile Crisis, the inflation-driven bear markets of the 1970s and 80s, Black Monday, the dot-com bubble, the 2008 financial crisis, the COVID-19 pandemic, the war in Ukraine, and now Trump's trade war. Despite all these bear markets and corrections, the S&P 500 has always recovered and reached new highs over the long run. This is because of the US strong economic growth, GDP growth, productivity gains, innovation, strong employment, stable inflation, and steadily growing corporate earnings. Now, whenever there's a large correction, I like to review the essay Buy American I Am by Warren Buffett. Buffett published this essay at the bottom of the 2008 financial crisis. He said, "The financial world is a mess, both in the United States and abroad, and its problems, moreover, have been leaking into the general economy, and the leaks are now turning into a gusher. In the near term, unemployment will rise, business activity falter, and headlines will continue to be scary." So I've been buying American stocks. This is my personal account I'm talking about, in which I previously owned nothing but United States government bonds. If prices keep looking attractive, my non-Berkshire net worth will soon be 100% in the United States equities. Why? A simple rule dictates my buying. Be fearful when the others are greedy, and be greedy when others are fearful. And most certainly, fear is now widespread, gripping even seasoned investors. To be sure, investors are right to be wary of highly leveraged entities or businesses in weak competitive positions. But fears regarding the long-term prosperity of the nations, many sound companies make no sense. These businesses will indeed suffer earnings hiccups, as they always have, but most major companies will be setting new profit record 5, 10, and 20 years from now. Let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So if you wait for the robins, spring will be over. Equities will almost certainly outperform cash over the next decade, probably by a substantial degree. Those investors who cling now to cash are betting they can efficiently time their move away from it later. In waiting for the comfort of good news, they're ignoring when Gretzky so advised, "I skate to where the puck is going to be, not to where it has been." I don't like to opine on the stock market, and again, I emphasize that I have no idea what the market will do in the short term. Nevertheless, I'll follow the lead of Irrational that opened in an empty bank building and then advertised, "Put your mouth where your money was." Today, my money and my mouth both say equities. Buffett also shared this in his past shareholder letters. He explained that he and Charlie are business pickers. They are not stock pickers. In fact, they don't time the market at all. What they like to do is to buy and own a group of outstanding businesses and buy them at fair prices. I believe we can learn a lot from Buffett's investing principles. Berkshire owns a wide variety of businesses, some in their entirety, some only in part. The second group largely consists of marketable common stocks of major American companies. Additionally, we own a few non-US equities and participate in several joint ventures or other collaborative activities. Whatever our form of ownership, our goal is to have meaningful investments in businesses with both durable economic advantage and a first-class CEO. Please note particularly that we own stocks based upon our expectations about their long-term business performance and not because we view them as vehicles for timely market moves. That point is crucial. Charlie and I are not stock pickers, we are business pickers. I make many mistakes. Consequently, our extensive collection of businesses includes some enterprises that have truly extraordinary economics, many others that enjoy good economic characteristics, and a few that are marginal. One advantage of our common stock segment is that on occasion, it becomes easy to buy pieces of wonderful businesses at wonderful prices. That shooting fish in a barrel experience is very rare in negotiated transactions and never occurs en masse. It's also far easier to exit from a mistake when it has been made in the marketable arena. At Berkshire, we hope and expect to pay much more in taxes during the next decade. We all the country know this. America's dynamism has made a huge contribution to whatever success Berkshire has achieved, a contribution Berkshire will always need. We count on the American tailwind. And though it has been become from time to time, its propelling force has always returned. I have been investing for 80 years, more than 1/3 of our country's lifetime. Despite our citizens' penchant, almost enthusiasm for self-criticism and self-doubt, I have yet to see a time where it makes sense to make a long-term bet against America. And I doubt very much that any reader of this letter will have a different experience in the future. Now, all these are only my opinions and my analysis that's based on my research. They are not financial wise. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.